Your electricity bill may rise for reasons unrelated to you. The machines driving the AI boom consume enormous power. Data centers now rank among the fastest growing electricity consumers globally. That demand is climbing faster than the power grid can respond. For long term investors, that gap carries real financial consequences. Utility stocks, industrial companies, and household costs all connect here. Understanding the chain helps you see what your portfolio holds. Start with the scale of what is happening right now. A single large AI data center can draw hundreds of megawatts. That is enough electricity to power a mid-sized city neighborhood. NVIDIA reported this year that AI computing clusters keep expanding. Multiple hyperscale facilities are under construction across the United States and Canada. Microsoft, Google, and Amazon have each committed hundreds of billions to infrastructure. That infrastructure runs on electricity every hour, every day, without interruption. The demand signal is already visible in utility earnings reports. Several major North American utilities have revised their long-term load forecasts upward. Dominion Energy and Duke Energy both cited data center growth explicitly. Load forecasts that were flat a decade ago are now rising sharply. This matters because utilities plan generating capacity decades in advance. When demand accelerates unexpectedly, the supply response takes time and capital. That lag between demand and supply is where pressure builds. Here is how that pressure travels through the economy. Utilities facing rising demand must build new generating capacity quickly. New natural gas plants, grid upgrades, and transmission lines cost billions. That capital has to come from somewhere, either debt or rate increases. Regulatory commissions in most U.S. states allow utilities to recover capital costs. Recovery happens through rate increases applied to all electricity customers. Households and businesses share that burden, whether they use AI or not. In Canada, provincial utilities follow similar cost recovery frameworks. Ontario, Alberta, and British Columbia all face growing data center interest. Industrial electricity rates in some provinces are already under review. Australian and UK grid operators have flagged comparable demand acceleration. The mechanism is the same across markets, though the timing differs. Capital investment flows in, costs accumulate, and rates adjust over time. For retirement investors, the exposure runs through several channels simultaneously. Index funds typically hold significant weight in utility companies. Rising capital spending can pressure utility free cash flow in the near term. Dividend growth, which many retirees depend on, may slow during heavy investment cycles. At the same time, utilities with large data center contracts may see long-term revenue stability. The contract lengths involved often run 10 to 20 years. That predictability carries its own value for income-oriented investors. The broader industrial economy feels this too, not just households. Manufacturers, logistics companies, and retailers all pay commercial electricity rates. If rates rise meaningfully, operating margins face quiet but persistent pressure. Companies with high electricity intensity, like metals producers and chemical firms, feel this most acutely. Those businesses often appear inside broad equity index funds without obvious labeling. A pension fund holding a diversified industrial ETF may carry this exposure indirectly. The connection is real even when the link is not obvious. There is also a more structural question forming around grid reliability. Power grids were not designed for this pace of demand growth. Transformer shortages, transmission bottlenecks, and permitting delays already affect grid expansion. The American Society of Civil Engineers has repeatedly flagged grid underinvestment for years. Adding concentrated, high-density AI load onto an aging system introduces new reliability risk. Blackouts and voltage instability can disrupt the very data centers driving the growth. That feedback loop is something grid planners and regulators are actively watching. One important counter-argument deserves honest consideration here. Energy efficiency in AI hardware has improved significantly and continues improving. NVIDIA's newer chip generations deliver more computation per unit of electricity consumed. If efficiency gains outpace demand growth, the electricity pressure could moderate substantially. Some analysts argue that software optimization and model compression will reduce overall energy intensity. Renewable energy development is also accelerating, adding new supply to stressed grids. The counter-argument is real and should not be dismissed by investors. What remains genuinely uncertain is whether efficiency gains will arrive fast enough. History offers a partial comparison worth considering carefully. The internet build-out of the late 1990s also created unexpected electricity demand. Server farms multiplied, cooling requirements surged, and utility planners scrambled to respond. Electricity demand forecasts from that era proved too conservative within several years. The difference today is that AI computing is more power dense than early server infrastructure. A modern AI training cluster consumes far more electricity per square meter than 1999 servers did. The analogy holds directionally, but the magnitude appears larger this time. History provides useful framing, not a guaranteed outcome. Now, consider three indicators worth monitoring as this story develops. The first is utility capital expenditure guidance in quarterly earnings calls. When utilities raise their 5-year spending plans, that signals accelerating demand they are pricing in. Rising capex today often leads to rate increase applications within 1 to 3 years. The second indicator is grid interconnection queue data published by regional grid operators. In the United States, FERC and independent system operators publish these figures publicly. A growing queue of data center connection requests confirms the demand pressure is real and sustained. The third indicator is industrial electricity price indices tracked by the U.S. Energy Information Administration. Rising commercial and industrial rates ahead of residential rates often signal data center concentration effects. These three signals together tell you whether the pressure is building or moderating. If you hold broad equity index funds, this theme already touches your portfolio. Utilities, industrials, and real estate investment trusts that own data center properties all connect here. None of that makes any specific company automatically attractive or automatically risky. What it does mean is that electricity cost trends deserve attention from long-term investors. Portfolios built around dividend income from utilities may face a different environment than in recent decades. The stable, slow growth utility model is being disrupted by a demand shift few expected this quickly. Whether that disruption creates opportunity or pressure depends heavily on execution and regulation. Subscribe to WealthMind's Hub for one clear macro to portfolio signal explained every week. The AI electricity story is not about one company or one quarter. It is about a structural shift in how power grids are used and financed. The question worth sitting with is this: does your portfolio reflect that shift yet?